Welcome back. We've got a stellar panel here. It's going to address issues about getting your startup ready for fundraising. We have experienced investors and legal advisors that'll be able to give you the lay of the land and then also answer questions you might have. So let me turn it over to Patrice Kloss, a partner at Fox Rothschild, who will moderate the panel. Thank you, Patrice.
Thanks, Steve. And thanks so much to Twin Cities Startup Week and also the Education and Training Track for inviting us to give this presentation. We're very excited. The topic of our presentation is preparing for your startup for a fundraising and letting you know all the things that you need to know before you begin. So to start out with, Steve had mentioned, my name is Patrice Kloss. I'm a partner at Fox Rothschild. I'm also the administrator of the corporate group in Fox's Minneapolis office. And I regularly work with investors, emerging companies, and VCs with respect to debt and equity financings.
Good afternoon, everybody. Thanks for being here. My name is Pam York. I am the co-founder and a managing partner of a firm called Capita3. We are an early-stage venture capital group. We invest in women CEOs and companies that are innovating in health and healthcare. So primarily early stage, pre-seed, seed, Series A for our investments, and happy to talk more about that later. As for me personally, I have done a lot of different things in my career. I started with a PhD in electrical engineering, and then from there kind of found my way to the startup world and really got the startup bug. Was a co-founder of 2 startups that both had exits, and then eventually found my way to investing. So very happy to be here.
Good afternoon. My name is Kathryn Dehn. I'm a corporate associate at Fox Rothschild. I help companies all the way from incorporation to an exit, everything in between, but I spend most of my time doing financings with companies.
Josh? Josh? Can you introduce yourself?
Hello, everyone. Josh Slayton, Senior Vice President of Corporate Development and Impact Investing for ECMC Group. I hope everyone can hear me because I actually could not hear everybody that was speaking. So I just popped up on the screen here and assume I'm giving myself an intro, and I've emailed it. Oh, he's texting me right now. Anyways, so Senior Vice President of Corporate Development, Impact Investing. I run our $250 million corporate venture fund out of ECMC Group, where we are focused on post-secondary and workforce solutions. So everything from kind of seed to later series investments, as well as doing LP commitments for a small set of strategically aligned GPs.
Thanks, Josh. So just as a bit of housekeeping, we welcome questions throughout. We've tried to stage the performance or the presentation to address many questions that people have. But if you're online, please feel free to text in messages. And if you're here, please feel free to ask questions so that we can tailor the presentation to what you need to know. So our first slide is raising capital is hard. You're going to hear no a lot. This is Josh's slide. And if you look at the percentage he has there, the majority of venture capital funds invest in less than 1% of the companies they meet with. So that shows you that there's no bad thing about hearing no, that statistically it's going to happen. But what we're trying to do here is to give you the kind of information so that put your best foot forward and are able to be very successful in your fundraising efforts. So the next slide, Josh, can you handle this one?
Josh isn't here enough. We had him up just a minute ago, so if you can talk through it.
Yep. Okay, so the next slide is protecting against the no, and if you aren't prepared for fundraising, you will not be in a position to succeed. So here are basic messages to get your house in order. There are a bunch of things that we're going to talk about, of things that corporate preparation that you need to have done before you start your fundraising. And also, we want to also teach you about a term sheet, what the provisions are, what you need to know about those so that you're ready when you get your first term sheet. But the other things are just basically having your slide deck ready, making sure you have your messaging correct, making sure you understand the questions that investors will ask of you, and so that you're ready with answers. Pam, is there anything else you want to add to that?
Sure, I'll just jump in, getting back to the 1% get invested. I mean, all of us on this panel are people that really want to help startups and entrepreneurs, and so it's probably the hardest part of what we do is not everybody's a fit for investors. And so even beyond, what Patrice had described, just really taking the time to understand what kind of company is investable by venture capital investors and angels, and then making sure that you are getting prepared for that in terms of what you're presenting to those investors. And happy to take any questions about what that would be, but understanding the requirements is really a key to being one of the 1%.
Pam, you want to handle this one?
Sure. Let us know when we have Josh back on so he can jump in.
Okay. He's here.
Okay, very good. So one of the things that you can do in terms of understanding if I'm one of the 1% that gets investment, looking at one set of criteria, which is what stage am I? So there's a couple stages of investment listed here. There's pre-seed, which is kind of the company's just formed and hasn't really made very much progress. Another really important stage is seed stage, where there's been a bit more progress, maybe some proof of concept. Perhaps you have a beta that you can demonstrate. And then Series A is where a lot of institutional, professional institutional investors come in at Series A. So pre-seed and seed stage, you might be seeing more angel investors, although some institutional VCs as well at the seed stage. And so understanding what stage am I, and then understanding what to explain in terms of where you are in your process. So if you're at Series A, you would need to have had revenue generation. You would need to have customers. You would need to have a filled out team, or at least a strong team. And so understanding if you're going for Series A investment, that's the kind of information that investors would be looking for, versus pre-seed is really more just, it's almost just like an idea and maybe a founder or two. And one of the things that you can do is there's a wealth of information, and stop me anytime, Patrice, if you want to jump in, but there's a wealth of information that you can just get by Googling, what's the average valuation of a seed stage company in ed tech, or how many startups got financed last year and what was the average financing amount at the seed stage in ed tech, or whatever field you're in. You can get a ton of what we call market comparables, so that you can start to get a feeling for, here's the boundaries of the space that I'm in. If I'm way outside those boundaries, then I need to be able to explain why my valuation's higher, or why I don't have as much progress as I think that maybe others would like to see.
And Pam, can you tell us how, with each stage of financing, how much control of the company an investor would normally want to take? So like, say for a A financing, what percentage of the company, depending, on the size of the investment, they would be looking at?
Yeah, I think it's one way to answer that, and as well as I do, so jump in too, but it's at the Series A is where founders often start to drop below 50% ownership in the company. So if you're at pre-seed stage, your investors might be looking to take 10%, 20% of the company, 25% of the company, so the founders and the company would still own a vast majority, and then at seed stage, it might be a little bit more. So that's also a key consideration. When am I willing to lose control over the shares of my company?
All right, the next is really understanding and knowing what your story is, what the value you bring to the market and to the investor, and being able to really articulate that correctly. We also, you need to have a deck and a presentation deck that you're going to be giving, and also be prepared to answer the kinds of questions that the investors will put forth to you. Pam, can you talk a little bit about what you like to see in investor deck?
Sure. I think a lot of people have this idea that if they can just kind of corner an investor and give them their whole pitch, that that's what they need to do to find out if someone's interested. every investor is different, but for me and what I see with a lot of my colleagues is I'm trying to see if there's just at the top line a fit. Are they the right stage? Is the valuation somewhere in the realm of what I think is reasonable? Are they in an industry space that I'm interested in? And so making sure that you understand if you're a fit for that investor. I saw once the example of, if you're a company that is building a meat product, you wouldn't go to someone who only invests in plant-based companies, right? So it's just kind of a funny example, but really understanding what these investors are looking for. And then beyond that, we're looking for a really strong early team. They don't have to have all the experience in the world. They just have to demonstrate that they have critical insight into what's happening in the marketplace that they're selling into, almost like a competitive advantage because of the insight that they have and an understanding of how to capture that market. That's probably number one. Aside from a very significant market, if it's under $1 billion, it's typically not that attractive. And then understanding really where they are with the product. It's really nice when companies already have proof of concept, when they already have revenue, because then they've proven it out. But we're often investing at stages that are pre-revenue, in which case we really want to understand the technology, what you've done to prove it out. And really, I think one of the things that is really great to do is to project forward in time. Here are the steps that I need to take in order to prove this out, because you're building confidence in investors. You have almost no operating history as an early company, and it's this process of building confidence that you understand what to do, or you can course correct as you learn more, and then you do what you say you're going to do by delivering on your plan.
And Pam, could you talk a little bit too about what different investors bring to the table? Because I think not all investors are created equal. They bring different things, and then you want to look for an investor who maybe can help you get to the next stage.
Yeah, that's really important, Patrice. And if you're a really early stage company, pre-seed or seed, it is really important to bring on investors who actually have some kind of expertise where they can help you. They understand the process of launching a new company, or they're domain experts in your field, or they have a lot of connections to other investors, sort of people that can almost be a pseudo operator, at a high level in your company, because you don't really have much of a team. And then as you get later on into later stages, it becomes more about the money and the follow-on money that's available as the company grows.
And then another thing, we have Josh. Josh, can you hear us? Josh, have you been listening?
I can hear you.
We've been keeping you.
I have not heard. Yes.
Well, we're talking about the things that you want to be able to communicate to an investor in your investor deck and in the conversations that you're having. You want to give us your thoughts on that as well.
Sure, and I apologize for the technical difficulties, and I'll just chalk it up to COVID. One more thing to COVID. I'm usually reliant on Patrice and Pam in many ways when we're looking at things. So this just a perfect example of that. I joined just as Pam was talking about the types of investors and what you're looking for. It's hyper critical as you think about them as a strategic partner, right? And you want them to be able to provide perspective on the markets, access to the markets, whether it's networks. And then for those that, especially for these technology platforms, that is very much, they have expertise in the types of platforms you're building, whether it's B2C, B2B, just so you're building it together, right? I mean, you're both invested in different ways, but invested in it together. So I think it's, do your homework on who you want to be in that round. And obviously, we started off this presentation with you're going to hear no a lot, but there are a lot of experienced and good investors out there. So be pretty prescriptive about what you're looking for.
Another thing I get asked about a lot is what's a good way for people, if they haven't done an investor presentation yet, to get kind of practice with that? I mean, do you recommend that people go talk to angel groups or other things like that, or they should just go to their friends and family and give this speech, or what do you think?
Yeah, don't go to friends and family. They'll provide you too good of feedback. Yeah, no, I think there's a lot of people out there, and maybe go to investors that would not be interested in investing with you, because I think most investors like to give feedback, they like to provide their perspective, and they like to help. And I do it on a fairly regular occasion where I'll be contacted by someone that doesn't fit our investment thesis, but happy to meet with them and give feedback, and also, potentially provide some networking to them and introductions to them. And I think that's probably your best path, is try it out on someone that's doing this, but you're not necessarily going to them for that investment.
And that's a great point, that it is a really close community. And so there's many people who are really willing to help with things like that. And keep in mind that, if someone's willing to do that for you, you give them the best pitch you can, but you have to know that they're not going to invest, most likely. So you're probably not going to spring them over,
Right.
but they can still give you great feedback. That's really helpful. So.
Yeah, and I would just say, especially for people raising for the first time, I think a lot of people just don't realize the preparation that's required to do fundraising. And if you thought of, you wouldn't just show up in front of a customer and just start talking, right? And I think you should treat investors the same way. It's really doing your research, understanding who they are. We always tell people to have a plan. And here's my friendlies. These are people that are experts in the area, but it's okay if they aren't interested in investing or they want to help me. You pitch to people that are friendly so that you can get the hard feedback, and then keep the investors you're most interested in until later in the process so that you get the kinks worked out. Because it can take, I personally have raised a number of times, and it's just amazing how every time you do it, it just takes quite a few pitches to get the kinks worked out and to really be putting your best foot forward.
And then the last thing I wanted to hit on is the information you put in your deck. So a lot of people think, well, if I'm going to give a presentation, then I need an NDA in place. And that's not super practical with respect to everybody you're going to be pitching, and not everybody's going to want to sign an NDA. So instead, you want to make sure that what's in your deck is information that is public and that you're fine with sharing. And then to the extent that you have trade secrets or secret sauce or something, that would be something that you would not share until you knew that an investor was super interested in you and was in the process of doing diligence. Because an investor will, if they are interested, they'll then open a round of diligence on you. And then at that point, you could talk about entering into an NDA or something like that. But the first round is just to be very protective about the information that you let out.
Hey, Patrice, can I add to that?
Absolutely.
Yeah. I mean, I think even taking that a little further, as an investor, our reputation is on being able to have these conversations, right? And so as you said, we don't sign NDAs kind of right away unless we're going to diligence. But we do expect to have a pretty open and real conversation with the founders on what they're doing, and we don't share that information, obviously, and because if we did, that would get back to us, and that's our reputation as an investor. So I think you go back to your comment on it's a small community, an inclusive community, and that matters to how we operate as well.
Agreed. That's a great point. Oh, question.
I have a comment from Scott McLean. He said, what about going to co-working spaces, incubators, accelerators, et cetera, for pitch feedback?
I think that's a great place to go. There's so many great organizations that are set up here to really do that kind of thing. So I think look in your community, obviously reach out to your contacts as well. But anything, whether you give your pitch to somebody who's formed to give feedback like that, or to an investor, I think it's also just the same helpful. So
Maybe just another comment, Patrice. Was it Scott? Yeah, Scott, thanks for bringing that up, because especially for really early stage companies, the purpose of most accelerators is to prepare you to go out and raise financing. So, and there's thousands of them, and many in the Twin Cities. So if you have the ability to get into an accelerator, it's a really great way to be walked through that process of how to get ready to raise financing.
Well, or just apply to that accelerator, right? We run an accelerator in education and workforce. We had 525 applications. We accepted 5, but we gave feedback to pretty much all of them.
So that's another great point. Okay, so the next group of things we're going to talk about are things you should do before you start a financing process. So these are kind of granular corporate things that if you don't do them correctly, it'll be found out in the diligence process. And that could, although some of these things can be fixed, it might make the investor think twice about you. So I think these are super good things to think about before you start. Kathryn, can you start with this?
Sure. Thanks, Patrice. So as a founder, one of the first decisions you'll have to make about your company is whether to organize as an LLC or as a C Corp. So as an initial matter, most VCs aren't willing to invest in LLCs. So it's just good to know right off the bat. Most of the time it's because it's much more difficult for investors to get their money out of a LLC than it is to get it out of a C Corp. So, and then when you get a number of investors, it just gets exponentially more complicated. So typically, if you're at any point planning on taking money from a VC, you'll want to be a C Corp. There are some advantages to being an LLC. Most of those are tax related, but it's usually you only see LLCs when you only have a few investors, you're never going to take VC money, you're not going to have a stock option plan, you don't have a planned exit, that type of thing. There is a mechanism for converting if you're currently an LLC and you want to become a C Corp. It's a fairly complicated process, so it's something you'll definitely want an attorney to help with. But if you're truly a very early stage company, it's not that difficult to do. But if you already have a lot of investors and you already have multiple series of stock, it's going to be a lot more complicated to convert.
Though Kathryn and I have converted many LLCs in our life, so it can be done. So.
Definitely.
All right, so the next thing is about IP. So oftentimes I'll meet a founder and they'll say to me, well, the IP for the company is in my name. It's not in the company's name. And I prefer to keep it that way or something like that. And I just have to say that that's not a super helpful position to take, and that when investors invest in you, they want the intellectual property to be held into the company that they're going to be investing in. So really keep that in mind. When you are forming your company, you should be transferring into the new company any IP that you've created or that the IP will be using or that the company will be using. And then also it's very important that anyone involved in the company who is working on intellectual property issues, that they've signed an assignment of IP prior to beginning their work. That's kind of important because if you have to have consideration when you sign that, and so if someone's already started to work, then you'd have to pay them additional consideration. So these are kind of gotchas that are really best if you can take care of right at the beginning. Oh, question.
Another question from a virtual audience member. Jeff Bennett asks, what are your views on using crowdfunding at early company stages? Does this hurt future raise opportunities with VCs?
So I would say we generally advise our clients not to turn to crowdfunding if at all possible. The problem with that is that you end up having a lot of investors who are unaccredited, and that can be problematic in the future with getting your certain clearances that you need for doing future financing rounds. So I don't know, Pam, if you've got other thoughts on that.
Well, beyond that, it's just, if you think about what it would take to raise money in crowdfunding, that's more of like you're marketing to consumers, so to speak. It's a whole skill set and level of preparation that's very different than getting investment from angels and VCs. And so it's just potentially a distraction. But if it can be done without causing cap table problems, without causing people who aren't accredited, we've seen it. It's not terrible. It's just not common.
Yeah. I think once or twice and talk to an attorney about it before you go that route. So.
Other than you think.
Oh, I'm putting the wrong.
Yep,
way.
that's
I'm
okay.
sorry.
There you go.
There we go.
So
there we go.
perfect. So It's similar to what Patrice was explaining. Anytime you hire an employee, a consultant, a service provider, founders will want to get in the habit of asking them to sign a confidentiality agreement. So these agreements have two main provisions. The first is obviously the confidentiality provision, which protects any of the company's confidential information. And the second is the assignment of invention rights. And so if any of the service providers develop any IP or any improvements to your technology, that type of thing, that all of that will automatically get assigned to the company. Sometimes in these agreements, you'll see a non-compete clause. It's not too common, but if you have a service provider that works full-time with the company, like maybe a contract CFO or someone that's working pretty much full-time for your company that's a consultant, sometimes you'll see a request for a non-competition clause. And finally, like Patrice was explaining, investors will ask, one of the questions in diligence is always, has every service provider signed a confidentiality and assignment of inventions clause or agreement? And if they haven't, then that's going to be a red flag for the investors, or they're going to ask the investor to go back and figure out how you can get these folks to sign these at that point. So good just to get in the habit of doing it early.
Agreed. Okay, next is capitalization. So when you are going to raise money, you'll be expected to have a capitalization table. It should be accurate. It should represent your fully diluted capitalization of the company. And when we say fully diluted, we mean all the stock that's issued, including all options to purchase stock that are out there, including warrants that might be issued to purchase stock, and then also including any other right that someone might have to purchase stock in your company, be that put into some agreement somewhere or anything. You really need to show exactly what's issued and what has the ability of being issued at this point. And then you also, to the extent you've been raising funds with convertible notes or safes, you want to make sure that those are also shown on the cap table so that people can understand that when the money goes in, these are the notes that will convert at the same time, or the safes that will convert. They want to be able to see the discount that might follow those notes and safes, and make sure that the investor looking at that can really see the company now and what it will be post-funding. So it's super important to have that in order right away. Pam, you want to talk a little bit about option pools and what you consider the right amount of option pool?
Sure, but I wonder if it's first worth asking if everybody understands what a capitalization table is. Does everyone understand that? Okay. Pardon me? Patrice?
So a capitalization table it's generally an Excel spreadsheet. It'll say the name of each stockholder along with the type of stock it owns. And there'll be usually two columns. One would be for stock that's issued right now, and the other thing is stock that's capable of being issued pursuant to a warrant or an option. So that's how that would be. And then you would also have probably a setting for where you're going to have your convertible notes or safes that might be converting. So this is really important for, a lot of people don't understand this, but like if someone says, my pre-money valuation is blank, how you come up with the purchase price of your stock is the pre-money valuation divided by the fully diluted capitalization amount. And that, whatever divides out to be a price. And so that's how that's determined, and that's why they want to have that fully diluted capitalization correct, because if all of a sudden you say, my fully diluted capitalization is 10,000 shares, and then somebody finds 15,000 somewhere else because you had some options you didn't put on there, then all of a sudden that changes the price. So
usually the cap table oftentimes will also include a ownership percentage, so you can quickly look at it and see this company owns this percent of the target company, this percent. So it's a nice snapshot of how the ownership is divvied up of the company.
Go ahead.
Do you have any general guidance on how many initial shares to issue in total? Certainly it varies depending on the company, but general thoughts on that?
So, it's the most important thing is percentage ownership versus the number of shares. So you could have, a lot of times I try to work it out so that when you end up doing your first financing, your shares will be priced at around $1 or something like that. So you can do that ahead of time, but in the end of the day, it doesn't really matter. It's more or less what your percentage ownership is. So versus a number of shares. So it's just something that if you have something in mind about saying, I feel like this is a good price to be having if my pre-money was this, you can back that out, but it doesn't matter a lot. So I see Series A financings that are priced at $1 and that are priced at $10, but it's more or less, it's the amount of, it's the percentage of the company you're buying, not the number of shares, so. Go ahead.
From an investor perspective, oh, sure. From an investor perspective, can you comment on your preference for convertible notes or safe notes or preferred common stock?
It really depends on the situation. I mean, we've invested in companies with convertible notes. We've invested in companies that are priced. It just depends on the circumstances. There's pros and cons to both. It's almost like the story has to be consistent for what they're trying to do. When it's a company that's trying to raise money quickly, they don't want to spend a lot of time pricing the company. Sometimes a convertible note would make sense. For later rounds of financing, like a Series A, you would expect that to be a priced round, unless it's like what's called a bridge to a Series A, where it's kind of like a loan to get them through a few months to get to the point where they can close on a Series A.
And a lot of times I think it's also based on the circumstances. You might not be at a place where you can raise a lot of money, but you still need money to keep going. So then it would make sense to do a convertible note or a safe, because then you're basically kicking valuation down the road, but the person who puts money in still gets the benefit of the valuation that other people determine later.
Maybe Josh wanted to answer the question.
Yeah.
Add to that. I'm trying to wave over here. No, I think so much of it comes down to what you're trying to get out of it as an investor, right? And what you can put in. We're going to go through some term sheets, information and protective provisions, et cetera. But if we're going into a round and we want to be a strategic partner, and that means we want to have a board seat or certain information rights, or pro rata into the next round, sometimes that's harder to do within a convertible note. It doesn't mean it can't be done. So I think our preference is many times aligned with what we're doing the investment for. If it's sometimes just geared more towards a passive investment, we're probably more fine with a note and just kind of a side letter on some information rights. If we're really trying to do it as a strategic investor, I think a normal price round sometimes allows you to get some of those provisions that make more sense for us as an investor.
Yeah, I think that's a great point, Josh. There's more certainty in a priced round with all the terms spelled out, which is really nice to have. Whereas in a convertible note, it's like what price is it going to convert into in the next round? And especially if the valuation is pretty low, then having a priced round is probably always preferable.
Good point. All right, so next we're just going to go through various terms in a term sheet and just talk about what they mean, what you should be concerned about with each one, and please feel free to ask questions as we go through, because some of these are pretty esoteric, and we're here to teach if we can. So the first one is valuation. That's the biggest term. That's what everybody cares about. It's obviously a totally non-legal term. Your valuation is what you think it is, but more than that, it's what the market thinks it is. So if you come out and you think you should be valued at such and such, and then everybody tells you, who you talk to thinks that you should be valued lower than that, you should be thinking about that and taking that into consideration. But Pam and Josh, do you guys want to kind of talk a little bit about your thoughts on valuation and how to best determine that?
Josh, go ahead.
Yeah, I'm happy to start. Yeah, to your point, Patrice, it's clearly the headline for when we talk to companies that we're looking to invest in. And I think it's sometimes as much art as science, right? Especially for early stage companies. And it's a bit of a function. You triangulate around, like, how much are they trying to raise? Well, how much they're trying to raise plays into how much our expectations are for, how much equity we want for participating in the round. And then what's that implied valuation that kind of works out to that? And then you think about it back from the market perspective. Does that make sense for where market comps are? But also, does it make sense for the market that they're operating within, right? I mean, I think this is an important point for companies. We're investing in something for, and underwriting it to anywhere from a 5 to 10 times return, right? So if we're investing at $20 million valuation, our expectation is that exit is anywhere from a $100 to $200 million exit, right? Does the market bear that? And what are the assumptions from their penetration of the market to get to that, and their scale in a short amount of time to get to that? So there's a fair amount of, kind of nuance, I think, as we look at valuation and what valuations make sense for each opportunity. But, it's not just from a founder's perspective. You can't go out with these super high valuations. We've seen this, and it gets to that, how do we get to a no really fast? Is expectations of a high valuation where the market doesn't bear, or you need 40% market share within a very short amount of time period, and it's just an unrealistic expectation. So I think it's Pam's point about what the market feedback is. You need be very well versed in the markets you're operating in, the size of that market, and then what market comps for companies of your type are going at.
Pam, you have anything you want to add to that, or?
Just that, everybody cares about valuation because it determines how much you own of the company and then ultimately how much you get when the company exits. So that's why it matters so much. But you definitely want to price the company to be able to raise money is really critical. That's as critical as how much you own of the company.
Agreed. Kathryn, you want to take the next one?
Sure. So the next provision that you always see in a term sheet is when the closing is going to be. This one is pretty straightforward, as you can imagine. Usually it just says, the closing will take place on or before X date. More often, we're seeing what are called tranched closings. So, for example, it'll say the first closing will take place on X date, and the second closing will take place upon the achievement of a certain milestone. Usually it's only 2 or 3 milestones, or it might even just be first closing on this date, second closing on this other date, 6 months down the road or something. So we're seeing that more and more. As far as timing goes, so from the date the term sheet is signed to the closing date, at least a month is usually what we see. If all the investors are on the same page, maybe there's not a lot of investors, everything goes pretty smoothly, a month is probably what you'll be expecting. And during that time, they'll be preparing documents, negotiating the documents, sending them back and forth between the company and the investors, conducting diligence, collecting signature pages, setting up wires, all of that type of thing. But when you're deciding what date you want your closing to be, you'll want to give yourself enough runway so that your company doesn't run out of money. So if your company is going to run out of money in October, you don't want your closing date to be October because you're not going to be able to make payroll, and that's going to be a problem. So you want to make sure you've given yourself enough runway so that if there are delays, and almost inevitably there will be, you're prepared for that.
That's a great point. So the next thing is board of directors. So your term sheet's going to set forth who's going to be on your board, and investors who invest a significant amount will expect to have a place on the board, or they may request to have a board observer position where they attend board meetings in a non-voting capacity. But I think the thing to keep in mind is that your board should be strategic. Every member on your board should bring something to the table. You should, obviously you have investors who are on your board, but you also, anyone who is not an investor should have a really strategic place on the board to be bringing some particular skills that you need. So, Pam and Josh, do you guys have anything to add to that about things you like to see on a board?
Sure. The one thing I would say is that a lot of companies very early stage think that they don't need a board and they don't have boards. And we really advocate for having a board right from the beginning, getting in that process. It's really a best practice. Having 3 members is usually pretty good, and it could be a founder, a strategic, and an investor, or if there's no investors yet, it could be 3 founders. But just really getting in that practice of understanding who do I need in this role to really help me with the company. And who's on the board has everything to do with what the company needs. But generally speaking, as we've been saying, you should have someone strategic who really understands your marketplace, and then you're likely to have investors if you've raised financing, and then you're most likely going to have a founder remaining on the board.
The only other thing I would add is the size of the board, right? Ensuring that your initial board is not too big, because every subsequent round, likely you're going to be adding board members, and you don't want an unwieldy or too large of a board to deal with.
A great book is Startup Boards by Brad Feld, and also he has a great book on raising money. So those are two must-read books from my library.
It's a great tip.
Great. The next provision that you'll see in every term sheet is on dividends. So dividends are when a company distributes profits to its shareholders. Usually in very early stage companies, this isn't a very negotiated provision because usually they haven't commercialized a product and there are no profits. So typically the provision just says that dividends will be declared or will be paid out if and when declared by the board. And even if there are a little bit of profits, typically both the investors and the company want those profits to go back into the company to contribute to its growth. So at least for very early stage companies, usually dividends aren't too negotiated.
Yeah, it's always there and never used. So these next few provisions we're going to go through pretty quickly, but please stop me if anyone has questions. Liquidation preference is really it's a key term for preferred stock, and it basically means that the preferred stock gets their money out first. So it's what's known as a downside protection. If the company were to liquidate and not have a lot of funds, the first funds would go towards paying off the purchase price paid by the preferred stock. That's what you're normally going to see on a Series A financing or a pre-Series A financing would be the preferred stock get 1x and then the rest go to the common stock. Now, what everybody wants to happen is that you're sold for enough money that it's better for the preferred stock to convert to common and take alongside the common stockholders, because your investors don't want just 1x. They want a better return on that. But this allows them the protection if things don't go well. And then the other things you'll see from time to time is participating preferred, and that means you get your 1x or your 2x or whatever you've negotiated, and then after that you participate with the common, so you never have to convert. And sometimes the participating preferred may be capped at like 3x or something like that. So you're usually not going to see that in very early rounds. You're just going to see your normal 1x. But if you do see participating preferred, that has a pretty big effect on the return of the company and the return that goes to the common stock. So you should really talk with your attorneys to make sure you understand how that works.
Protective provisions you'll see in every term sheet and every financing. Basically, this is protective provisions are when a series of or a class of stock has veto rights over certain corporate actions. So, for example, Series A investors might request that at least 60% of the Series A investors can have a veto over these major corporate actions. Usually, these are things like the company's getting acquired or liquidating or changing the size of the board, something like that. And the most important thing that we're looking for is just that no one investor has veto rights. So it's fine if an investor has to buddy up with another investor to veto certain corporate actions, but we don't want any one investor to be able to dictate how the future of the company will go.
Yep. And then just super quickly, anti-dilution is something that if you sell stock at a price lower than the price you sold preferred stock, it gives them a better adjustment and when they convert to common stock, so it pushes the dilution onto the common stockholders. Then a drag along is something that you want all your stockholders to be party to, so that when you sell the company, you don't have to worry about anyone holding up the sale on that. You want to rush to the rest?
Registration rights are very esoteric, but basically it's just protection for the investors that when the company goes public, they can force the company to register their securities so that they can sell them on the public market and they can get their money out of the company.
Yep. And I'm going to pretend like this slide doesn't exist, and we're going to go straight to our takeaways. So here is our advice for you. I want to say this, that the The last bullet point was written by Josh, so I don't want to think. I think he's right, but it wasn't written by me. But these are really just the things we've talked about. I think it makes sense to get these things in order before you start your fundraising process. And I just asked my panelists to maybe each give a final kind of thoughts on this. So, Josh.
Sure, you guys all started looking my way. Yeah, I mean, I think you started the conversation this way. Just be prepared. Take the time. You know, this is all about getting your house in order. You're never going to get to a yes right away. You very likely can get to a no right away if you're not prepared. And, you know, talk to counsel. Yes, I put that bullet point in there, but I speak from experience, you know, working with Patrice on a regular basis, that it's it's worth it to have to be able to go to good counsel or advisors that are in the market. And so spend the time, get your story right, get your house in order. I mean, this is what the whole idea of this conversation was, but it really, really does matter.
I would just say make it really, really easy as you can for people to understand who you are and what you're doing. And that takes time, especially when you're putting together a data room and other documents. It's very time consuming to do that.
All right. Thank you, guys. We appreciate it.
Yeah, let's hear it from the panel here. Thank you so much. Yeah.